Welcome to Opales TV. I am in Singapore together with Danny Yong. Danny Yong is one of the founders and the Chief Investment Officer of Dymon Asia. Dymon Asia is a global macro hedge fund focusing on the Asian region. Danny, I'm curious, how did you become a hedge fund manager?
A lot of luck. I think I had a good degree out of school in Singapore, and luck because I managed to get a job in JP Morgan in Singapore trading Asian currency derivatives.
When was that?
This was in 1997. When I say a lot of luck because it was a job where there was 1,000 applicants, and truly they narrowed it down to a field of 3, and they offered it to the first person who already had a job offer somewhere else, and then they offered it to the second person who happened to be a lady who also turned them down. So I was just right place at the right time.
You were number 3.
I was number 3 out of 1,000. You know, I think it was just a lot of luck and fate that I was given the opportunity. After 3 years at JP Morgan trading currency and interest rate derivatives, I moved to Goldman Sachs in Hong Kong. Again, a lot of luck involved. I was going to Hong Kong on a holiday, and I happened to know somebody in Goldman Sachs, and he says, why don't you come in and meet my boss? So I asked this guy, it's like, are you guys looking to hire a trader? And he said no, but he said at the same time Goldman Sachs is always looking for good traders. So it was, if I wasn't there on the holiday, I may have never been for this interview. And so through that casual meeting, I ended up getting an offer to join Goldman Sachs, which I did in early 2000 to be an interest rate derivatives trader. So I spent 6 years in Goldman Sachs, 3 years in Hong Kong, followed by 3 years in Tokyo. And then at that point, I felt that I wanted to take my career to a different place. I wanted to focus purely on prop, and thought that instead of trading prop just within the bank, I wanted to know what was out there. So at that point, I had an offer from Citadel to run Asia macro and relative value trading for them in Hong Kong. So I took that offer, and that's how I started my career in hedge funds. After a year and a half at Citadel, I decided to come out on my own with a few partners, and we started out in Hong Kong in a fund called ABEX Global Capital. And from ABEX Global Capital, we launched Dymon Asia Macro. We were fortunate enough to be seeded by Tudor Investment Corporation. In my mind, Tudor is the best macro fund there is in the world. I think it has a great culture. And if it wasn't for Tudor, back to the earlier point about luck, if it wasn't for Tudor being willing to seed us in the middle of 2008, just prior to the Lehman meltdown, Dymon Asia Capital wouldn't be here today.
This is a great CV, and I'm sure a lot of people would like to have a similar CV, like Goldman Sachs and then Citadel and being seeded by Tudor. So my question is, how do you get such a CV? Or what type of person are you? Or what type of person does one have to be to really succeed in these fields with these companies?
I think working hard in school and always being competitive and wanting to win is extremely important. For myself, it happened to be in sports in my earlier life. I used to play badminton for Singapore, and I think it's just, which is why I also emphasize sports for my kids. I think it can be sports, it could be the arts, but whatever you do, you must want to win. And I think that winning spirit will be something that will push you through, because as many people know, life as a hedge fund manager can be pretty tough. I think a natural curiosity is extremely important, like wanting to ask questions about why something happens. From a very young age, I was always the thorn in the behind for my mom and my dad and my sister, because I was asking about everything. So even today, for my kids, I encourage them to ask questions. I always have enough time to give them like a proper answer, so that in their lives down the road, whatever they may do, I think curiosity helps you to think out of the box. So for me, it's that. I think it's hard work, wanting to win, and curiosity.
Now your fund, Dymon Asia, is a global macro fund and you're focusing on Asia. So you have been trading Asia now for 15 years. And what is the evolution of global macro, the evolution of the markets and the opportunities that you see from your perspective?
In many ways, in the past, the US and the developed markets like Europe and Japan were the key drivers of global growth. But today, it's like global GDP growth is like 2/3 of GDP growth is from emerging markets, including Asia. At the same time, I'll think about, like the developed economies as the dog, and Asia and emerging markets used to be the tail. Except that the tail has now gotten a lot fatter because the world is a lot more evenly distributed. More than half of the world's population is in emerging markets, as well as the GDP growth, as we mentioned. What has changed is, I feel that global macro increasingly has to evolve, or will evolve into local macro. You have to be a lot closer to the ground because policies in Asia today does have an impact on what will happen in asset markets in the developed world. Again, in the past, everyone was very focused on monetary policy, say in the US. But today what China does, by the sheer size of China's economy, by the sheer size of the reserves that China manages, it will have an impact on other asset markets around the world. So I'd say it's just that evolution because of the size, evolution because of the reserves that are being managed out here, the importance of China, India, and all of Asia, as well as Brazil and Russia, has made like global macro less about developed markets and more about the world as a whole. So our advantage out here in Asia, it's like for us to be close to the ground and hopefully be able to be one step ahead of the crowd, one step ahead with respect to certain trends that we see developing in Asia. It's like the trends are now a lot longer term, sort of like the 10-year picture. I think it's pretty clear that Asian currencies will continue to strengthen, the dollar will continue to lose its store of wealth, and asset markets will continue to trend higher as the world tries to look for an alternative store of wealth. Right? It goes from the dollar, followed by the euro, and now the world is actually searching for the third reserve currency. We all know that there's no clear third reserve currency as yet. So it's going to be a basket of anything that's scarce. It could be gold, precious metals, it could be a basket of Asian currencies, commodities, both hard and soft, energy. And that is a trend that is clear to us. But again, because of the interconnectivity of the world today, even though you can see the 10-year picture clearly, but the next 1 month or the next 6 months or the next 1 year, there will be tremendous volatility because there are so many moving parts in the world. It could be sovereign issues in Europe. It could be whether we're exiting QE2 in the US. We're an earthquake in Japan, followed by arguably the policies of Japan could be seen as QE 2.5. The tightening in China in terms of reserve requirements and interest rates, the tightening in India and the rest of Asia. So all these moving parts would affect risk appetite in the short term, even though the longer term picture stays the same. So the way we at Dymon Asia look at it is, our job in the so-called shorter term end of the bucket is to manage your position sizes to allow you to stay in the game, to benefit from this eventuality. As I see it as an eventuality that equity markets will head higher in the long run and that Asian currencies will continue to strengthen. It's just that the path would be a lot less certain and the path would be a lot more volatile. Global macro in general has been a little bit more challenging in the last, I would say, 2 years. My view is global macro tends to do well when the markets are trending. And today things have changed because admin measures or macroprudential policies that China has been deploying for more than the last 10 years, which means like little tweaks are in the system, sort of like hiking reserve requirement, hiking stamp duties, putting regulations on how much property you can buy, restricting leverage, taxation on capital flows, restriction on capital flows. All those little tweaks actually go to reduce volatility. I would say global macro does well in markets where, say, hot money comes in from the rest of the world and it causes a huge asset bubble over a period of 3 to 5 years. That huge asset market, let's say equities going up 200 to 300%, that's a huge trend. And traditionally, that's where global macro tends to do well. Interest rates go up, equity markets go up. That tends to also be followed by a crash, where equity markets fall by 50 to 70% and interest rates as well plunge. But I think the world is now moving towards a slightly more stable phase for the moment, led by China. Macroprudential policies have in some ways gained a certain form of respectability. In the past, when China did all these little tweaks, it was used to be criticized as saying the policies are like whacking the mole. Whenever a little bubble emerges, they're trying to whack it, but the consensus view back then was it's not the right policy and it would eventually end in tears. But China has been doing it for more than 10 years. And arguably, China is still very stable and has actually survived the recent credit crisis in 2008 pretty well.
Danny, what is your longer term view on the markets and the different asset classes then?
Since World War II, the US dollar has served good function to effectively be the currency that helps to facilitate global trade. I think the US has come to a point because of the deficits that it's running right now, and arguably it could be in some ways in a death spiral. I don't mean this is something that will happen over the next few years, but it could be something that plays out in the next 20 to 30 years, that the world needs to find a new way to facilitate global trade, a new way to store wealth, as France is now pushing for in the G20 for the SDR as potentially as a substitute or a partial substitute for the US dollar. China as well is pretty open to the idea of the SDR. I think that is a good idea, and it will be the direction that the world heads towards over the next few years. Clearly that would have an impact on emerging market currencies like China, potentially like Brazil and Russia, India and the rest of the Asian currencies. I think if we take a step back, if you look from 2000 to today, if we were to look at the price changes of gold, it's up 6 times from the year 2000. Brent crude is up 6 times from the year 2000. If we were to look at the foreign exchange reserves of Asian central banks as a whole, it was about 1 trillion and today we're close to 6 trillion, also up about 6 times. If we look at high-end property prices across all of Asia and emerging markets, from China to Singapore to Hong Kong to Sydney, Melbourne, India, Thailand, high-end property prices, I mean, there's no reliable index, but anecdotally, high-end property prices are up about 6 to 7 times as well. So if you take a step back, is that a coincidence? That the growth in Asia central bank reserves, which would have a correlation to savings out here in Asia, has such a high correlation to the price rises of scarce assets. I mean, it's again like gold and oil. So to me, it's not a coincidence. It's a function of, as long as the deficit countries like the US and some parts of Europe continue to have to print money, asset prices have to go up. I believe that we need to distinguish between assets with social implications like real estate and food and soft commodities versus the other assets. And why I say that is because, as we have seen in the first quarter of this year, the Jasmine Revolution and the social unrest in the Middle East, a lot of it is a function of the people at the bottom or in the middle feeling squeezed in a way that they are no longer able to afford that same quality of life that they used to. And governments around the world, and it's already happening across all of Asia, are restricting investment flows into real estate. Because if they don't, and if that wall of money continues to push property prices out of the reach of the middle income or the man on the street, that will lead to social unrest. Food should not be something where it's commonly seen as a store of wealth as well. Because if that money goes into food, basically people cannot feed their families, and it will lead to social unrest as well. So the way I'm thinking about it is the wall of money continues to grow, but the world is looking for somewhere to store that money in order to try to at least keep up with inflation. And if, say, perhaps the next 10 years, the store of wealth of the US dollar could drop by a further 6 times, as we have seen in the last 10 years, and where would that money end up having to go? I think that it will actually end up going to equities. It's a 10-year view, not a short-term view, but equities is the one asset class where it's actually socially quite acceptable for it to go higher. If the S&P headed higher another 50% or another 100%, the man on the street actually does benefit, at least in the short term. You would see, because of the 401k and all the pension funds, generally equities going higher would be good for the man on the street. So in some ways, the new regulations in commodities, the CME is constantly increasing margins to discourage blatant speculation in some of the commodities for energy as well. At the same time, property has all the regulations, so that money has to go somewhere. And our view is over the next 10 years, it will go into equities, which actually is also a link to an ownership to potentially an asset that is scarce. You know, an interesting thing is if somebody told me at the end of last year that the world would face once-in-a-lifetime earthquake in Japan, in New Zealand, you would have tsunamis, like nuclear fallouts. You have oil prices going up 30% in 3 months because of the uncertainties in the Middle East, the floods in Australia, inflation problems, Asian central banks and emerging market central banks hiking interest rates. If you told me that at the end of 2010, I would have expected equity markets to be significantly lower. But as of today, the S&P, it's more than 7% higher than at the beginning of the year. Asian equity markets are doing well. Asian currencies are continuing to strengthen. So fundamentals are something that are very key that we focus on for the long term. But at the same time, I think what the markets are telling us is there is this wall of money that is now going through a portfolio rebalancing that's moving out from fixed income into riskier assets. And this move is not just based on like shorter term fundamentals, it's also based on investors actually needing to diversify and rebalance their portfolio. Many of the large global macro funds have offices out here in Asia, and I think that's absolutely the right move. In order to trade Asia or emerging markets or Brazil or Russia well, you have to be here in Asia. You have to be here in this time zone because so many things are going on, right? It's like the ability to see the central banks in Japan, to see the central banks and the government officials in China. You can only do that effectively if you are out here physically in Asia. So there's absolutely a war of talent going on as the large funds like Tudor, Soros, Fortress are all coming out here and looking to build out their Asia macro business. So I actually see that as something very positive because as more and more money comes out here to Asia to focus in the macro space, that means more and more investors are starting to see Asia macro as a real asset class. And what has changed for Asia macro in the last 5 years is that the liquidity of the markets is now significantly higher. The markets are a lot deeper today than they were even in 2005, and definitely when against say in the Asian crisis in 1997. So today you're able to put a much larger amount of money to work. I think Asia macro funds very soon will be running things like 2 billion and 3 billion purely because there is the liquidity. Like the FX markets are a lot deeper today. The FX options markets are a lot deeper. The interest rates markets, interest rate derivatives, the domestic markets in say Philippines, Indonesia, Malaysia, in China. And on the topic of China is opening up their markets very, very rapidly. I know most people would disagree with me, But I feel that the renminbi could become fully convertible in the next 2 to 3 years. And we have this new market in Hong Kong today called the CNH. Even then, if you just look at the currency alone, when it first started, the daily volumes were like 10 million. At the end of last year, in December of 2010, the daily volumes were 300 million. Today, the daily transaction volumes for the dollar versus the CNH is about $1 billion. And I think it will continue to grow as China pushes forward the use of the renminbi as a currency of trade with trading partners in Asia as well as all around the world. For us in Dymon Asia, we feel that the Asia proprietary trading space or the Asia hedge fund space, because it's still young relative to the macro space in the US and the UK, there aren't as many experienced managers that are able to manage, say, $300 to $500 million. Whereas there are a lot of very talented managers that can manage initially like $50 to $100 million. And for us, our goal is to build up a team driven by myself that will sort of spend time to actually give these guys the opportunity to trade, to grow, and eventually evolve into the managers that can run $300 to $500 million themselves. So it'll take a while, but I see the next 10 years as the years for Asia macro, where it was that way for the US in the mid-80s. It was that hedge fund had this tremendous growth in Europe in the 90s. And 2010, for at least the next decade, will be the time for Asia macro funds.